What's up, guys? I'm nobody special. And today, October 21st, 2025, is a date which will live in infamy, certainly among metals enthusiasts and precious metals traders. We saw one of, if not the most brutal sell-off gold and silver has ever seen in my day, certainly on a nominal basis, maybe not a percentage basis. Didn't have time to go back through history and make comparisons. But today was eerily reminiscent of that February 2021 sell-off in gold and silver. That is all too fresh in the minds of precious metals traders and silver squeezers alike. And so I have got the channel gold guy, Bob Coleman, the CEO of Idaho Armored Vaults, is with us today to help us make heads or tails of this. Bob, thank you so much for your time and for agreeing to do this on such short notice. How are you doing today, sir?
Sure. Been a busy day. Like we were saying off air, maybe one of these days I can come on your show when the market's not crashing.
Yeah, not crashing or not ripping. Just a normal Tuesday. That'd be kind of nice to do that. But it is not this day, Bob. Certainly not today. So look, I was in the dentist office waiting room. My daughter had a dentist appointment today, and I was trying to set up this interview and this spontaneous live stream. So it's been one heck of a morning. I'm going to need blood pressure medication by the time today is over. Bob, let's just cut to the chase. What the hell happened today?
Well, you had kind of a culmination of shorts getting squeezed last week. The sentiment was absolutely through the roof. I mean, the stuff I was reading last week on social media, that's the type of stuff you see at peaks in terms of just the fervor from the public. You got to look at it like in 2024 when early 2024, January, February timeframe, you couldn't sell a piece of metal to anyone or get anyone to buy any mining stocks. And last week it was like you couldn't. I don't think there was anybody not willing to sell. You had mainstream media come on. You had all these big wigs talking about buying gold, putting 20% of your portfolio. The basement trade and whatever else they want to call it. It was just like throwing gasoline on the fire. So you get these things. You had option expiration last week, which you had this sort of gamma squeeze in the options market. Then you had the issue with the enormous amount of shares being brought back into SLV yesterday. And that has been that's when we've talked about it before, it's been a pattern that authorized participants or option dealers that write calls when the public buys calls, they write calls. They have a lot of calls that were in the money. And so there was a lot of shares created even when the price dropped on Friday. And so you have that kind of to help quell some of the and I think a lot of this metal going to London from New York and other locations. And you got to remember, the metal that's going to London, it's not just simply coming from the COMEX, it's coming from refiners as well. So they're sending it sort of outside the channels, which is not talked about at all. But the combination of all that kind of put it was like I talked about on other programs. It's sending in metal or silver to London's like putting a fire hose on a house on fire. It'll start to slow down and kind of put out the fire a little bit. And that's exactly what happened. So you had massive implied volatility premiums built into the options market. So you had a lot of that unwinding, because you got to remember when option volatility premiums start to come down, the price of the option comes down. So you get this sort of flash type of move where everyone's starting to sell very quickly because the option price is moving down at an accelerated fashion, because not only intrinsic value, but also that volatility premium decay. So you have that, and then the short borrowing fee kind of subsided a little bit. So you probably saw a little bit of relief or relieving of pressure that's happening in London. But these are all things that, again, you try to anticipate. You don't try to say, listen, this is the end of the market or the end of the move. The market breathes, it goes up and down, and there's different types of things that happen week to week. So now you start to see the backwardation starting to come a little bit more in line. I think it was like 70 cents backwardated, if I'm not mistaken, at the end of the day. So you've seen that starting to come back in line. It's still very wide, but These are all things that you want to see a market stabilize with, because really, in essence, if the story is still valid, the long-term story on silver, this is what they call the buying opportunity. This is the big shake. This is getting the people that had rushed into the market, especially on the trading side, the ones that are on margin, on leverage, buying the mining stocks or the mining stock options and things like that. These are the moves that will shake you out.
So you talk about the shakeout there. That's a good segue, because we have seen that retail enthusiasm came back in a big way last week, in particular overseas. Honestly, I still don't quite see it in the States. I'm seeing pockets of it in the States and some anecdotes. But there's been videos of people queuing up around the block in Australia, stories about Japanese funds or Japanese dealers shutting down, Indian ETFs not taking any more purchases. And then, a lot of people see that as signs of a top. And then we get today, which you mentioned is shakeout. And in my opinion, all of the underlying things that drove this relentless rally in metals over the last, well, really 2 years, are still there, if not worse than they were. Was today just a shakeout of over leveraged plays, meaning, maybe we trade sideways, even down a little bit more from here, but then we resume on this rally? Or do you think the top is in?
No, I don't think the top is in. I think, the surprise would be actually we start going back up, because you got a lot of people that are potentially, this is a big move down, no question about it. But this is what, during big shakes like this, a bull market's designed to buck people off. And probably the Bitcoin people could probably attest to this probably more than anybody because of the volatility there. But these big drawdowns are designed to scare the living crap out of you. That's the idea. And so the question is, on the physical side, the advantage we have as physical investors is that, hey, listen, we're not on margin. We own this metal. It's long-term positioned. We don't care about the counterparty because we hold it directly. We're not on, it's not like owning a futures contract, that type of thing where you have time decay and all this other type of stuff. So in essence, if the story is real, people will be buying on the dip, and that buying will start to sort of plant the consolidation that you really want to see happen for the next levitation higher. You remember that this is a stair-step approach, and we had massive moves to the upside, especially the last couple of weeks. So it's not unnormal to see some type of retracement. That's just today I think in this world, with all the nuances of political developments and job owning and so forth. Every day is basically, a whole new day for the most part.
So you're a precious metal dealer, right? At Idaho Armored Vaults, you do storage and you also deal in physical. What'd you see today at your office? If you don't mind me asking a little bit, like what happened behind the scenes? Was it people getting bucked off, calling you, I want to close my position, I want to sell? Or did you get people calling to buy the dip today?
Oh, buy. I think talking to a few of the larger wholesalers in the country, I think that that primarily they were more 70-30, 80-20 type buying, more buying than selling. If you want to look at it maybe on a percentage basis. So you had this sort of idea where people were like, listen, I feel uneasy chasing the market higher, and it's one of those things where some people just they let the market come to them. They play the patience game, and today paid off. So you had some larger size purchases that were going in. I think I don't think it changes the complexion of the long-term focus. I think the problem we're running into is just this short-term narrative of and I see this a lot, and the promotion and the gold dealer community tends to literally dump gas on a fire when things are going up, really creating this expectation that, oh my God, this is it. It's going to 100 tomorrow. If you're not buying right now, you're going to be, the train's leaving the station. You're not going to get any. And that type of fervor is, I think, the worst thing that could happen in our industry, because it creates this emotional roller coaster for people, where they don't focus on the fundamentals. They're just focusing on, well, when are the banks going to fail? I thought this, silver's going to 200. It should have done this last year. And it's just sets the wrong expectations.
And I know you're chomping at the bit. There's one in particular that you want to get to, one video that was going around that you called out on Twitter, and we will give you a chance. We'll go through that one, and you can respond line by line to some of those practices that have always kind of made you grind your teeth. Real quick, I want to get into a little bit of the mechanics of what happened in the market over the last few days, because I'm going to go ahead and lump the last, say, 3 trading days into one. This really started on Friday. And we had that margin requirement increase on Thursday night that went into effect, I believe, Friday morning. Did that increase in margin requirements set this in motion, or did it just maybe played a role? It was a downward force on some of those margin positions.
Yeah, I don't know if the margin side on the futures, I don't think was the culprit as much as it was the options market. I think the options market, you saw this gamma squeeze, you saw dealers literally on the hook for, I think it was like 25 million potential shares that needed to be created, because that was the level of in the money calls that could have been exercised. And so there is this, this is the problem with the ETFs, is that there's a lot of influence there by the market makers and authorized participants to move the markets, take advantage of positions that are in their favor from time to time. It doesn't always work all the time, but I think some of this activity last week was going into that option expiration. Again, I'm not trying to throw out conspiracy and all that type of thing. Wall Street is Wall Street. Their job is to make money, period. The sentiment was through the roof. You had a lot of job owning. So you had a lot of fast money players maybe jumping into the market because it was just going vertical. A lot of momentum traders. Those guys get taken out. You got to remember, a lot of these guys trade on leverage, especially over in London in the contract for differences market, which trades massive leverage. I mean, we're talking 50x, type trades. 10x is very, very common. Those types of trades can create this very quick and sudden type of movement, and that movement then sort of snowballs into other markets. And I think that's where a lot of this came from, was more on the leverage and also option side of the business.
So I think you were kind of expecting this then, because I saw you posted yesterday that you were expecting a lot of SLV share creation. I think SLV was trading at a premium, correct me if I'm wrong, it was almost $2 to net asset value that the SLV was trading at. And then when you get that big, surge in the ETFs, there's going to be a big share creation coming. And of course, all the creation of that shares, it takes the price back down, but it also is supposed to go by the metal. And I know a lot of people, especially in the comments on my live stream this morning, were calling out that middle of the night prospectus change to the SLV ETF from 2021, where they revised it to say during periods of market turmoil, which I think this qualifies. During periods of market turmoil, they may not be able to immediately source the bars to represent those shares. And then this morning, you were proven correct. We had, I think it was, you wrote it down, I used it in my morning live, 9.65 million shares of SLV were created this morning, representing about 8.7 million ounces. And maybe you could recreate this exchange we had on email today. Is there any way for the average guy to go verify if the SLV actually bought those bars, or if they evoked that clause that says we don't have to go buy the bars?
No, the way the SLV puts out a bar list every day, and you can download that bar list, so you can actually see the hallmarks and the fineness, and I think it may even have the ounce weight on that bar. But to kind of back up a moment and just explain to people how the SLV works, or ETFs work in general, the commodity ETF products. Not talking about the ETNs, which are electronic trade notes or exchange trade notes. Those are more of a debt instrument, but the ETFs, for the authorized participant to create shares, they have to deliver metal to the fund, or to the I guess to the fund.
And the authorized participant is basically a bank, right, or a hedge fund, a big player.
Yeah. The authorized participant is, typical broker dealers. They're market makers. They're, the Goldman Sachs and Virtue Financial, and the big players out there. And I think there's 8 or 9 or 10 of them with SLV. They're very common. They create, a lot of these guys are becoming authorized participants for a lot of the same type of commodity funds. So what happens is, they have to go find the metal, and then they give the metal to, basically they put the metal into, for example, JP Morgan's vault, on their side of the account. And then there is what they call, and then on JP Morgan, or I'm sorry, on SLV side of the equation, they have their own allocated account. But when metal is put into and then transferred to the SLV, it actually goes into a process of into an unallocated account and then back into an allocated account. There's a little bit of a nuance there. And then once they deliver that metal, then the shares get created. In this instance, there's a time delay in that if they have the metal verified in London, for example, they can create those shares, because the shares are created at the end of New York's business day, but the metal isn't delivered until I think it's 9 o'clock the next morning in London. So there is a little bit of a difference when you look at the shares creation report versus the bar list report, for example. So it's just the time. It's just the nuance of the time delay and the shift and the transfer of metal going from one account to another. But they have to have the metal in that account. Otherwise, you're talking fraud. I mean, that would be the stupidest thing to do, is to have a physical oriented commodity fund and not have the product in there, because it could be audited at any time. And that's, I mean, I obviously will all have to trust, the custodian, the sponsor, and so forth. But in essence, that's the process that it goes through. Whether people believe it or not, that's another story. But I have to believe that there's metal there. Now, there's also commodity funds that are also non-physical. They're silver funds. They sound like a silver fund or a physical fund, but they're traded with futures contracts, for example. So they're backed by leveraged products that mimic the price action of silver, but they're not invested in physical silver.
So,
and just to let you, one other thing that people may not be aware of, the structured product market and structured ETF market, these 2 and 3x levered ETFs, for example, that go in and buy futures contracts, and they buy an outsized amount of contracts to get that leverage. You have to remember, they also, when you have these kind of capital flows coming into the precious metals markets, when that, it just as much as it runs it straight up, when that capital starts leaving, those levered products create an outside down move to the downside that's much greater than normal as well.
And those levered products just got absolutely destroyed today, right? I mean, if you were in those, which is why I always tell people, be careful on leverage, guys. Yeah, there's big gains, but you can get wiped out in an instant on leverage. So by tomorrow morning, then, if we say nothing better to do with our time, pull up the bar list, we should see thousands of new bars in that SLV bar list tomorrow, based on the shares that were created today, right?
Yeah, I didn't check the bar list today. I didn't pull it down. I did this morning, but I think I did it way too early. There should be an update to it. It's either, sometime during the day or probably tomorrow morning. But technically, those bars are moved into the next day. Whenever the shares are created the next day, those bars are moved into. So yeah, you're right. So probably either they already have their report out, or by tomorrow morning.
Okay, I appreciate that. So it sounds like the SLV, the new shares created, probably played a big role in the sell-off today. Now, at the same time, let's say the bars are there. They are on the bar list. That's, what did we say it was? 8.6 million ounces? I think I wrote the number down. I want to get my numbers right here, guys. Bear with me.
Yeah.
8.7.
And to give people an idea of the size and magnitude of silver, that is, when you're talking about, typically when you see 600,000 or so ounces being moved around at the COMEX, plus or minus, day to day, that's about the amount of silver that's in a cargo container. It's about 600,000. So you get an idea, you're talking, was it 14 or so cargo containers of silver coming in? That's a lot of metal.
Scientifically speaking, that's a metric ass ton of silver that they put in there. Yes, if you want to be technical about it. And that can work in reverse too, right? Let's say this sell-off goes crazy and everybody just dumps. They say, oh, it's 2011 all over again. We could see SLV start to trade at a discount to net asset value, in which case what would happen? Those bars would start leaving the trusts and add to the free float in London, right?
Yeah, you have to remember, and SLV puts up their the trading at discount or NAV. There's a chart that they have right on their site to show this. But you have to remember, the authorized participants' job is to create liquidity. It's to try and maintain, in some degree, 1 or 2, 3% within the NAV, within that par value or NAV value, the price of the fund. So when you go to a discount, for example, a sharp discount, authorized participants would be buying those shares, delivering the shares back to SLV and getting the more expensive metal out. And that's how they make money. That you have to remember, and I say this all the time, investors are, they think they're investing in a product, but they are the product. The authorized participant makes their money on the flow of money going in and out of these ETFs, and that's what I don't think that's probably explained enough in social media.
It's more of an arbitrage mechanism to make money for the authorized participants, whereas a lot of people, I think, just say, oh, it's used to suppress prices and manipulation. They can make money in both sides of this, right?
Right. Yes. And this is the difference between this and PSLV. PSLV is a closed-end fund. So when they create shares, they're actually selling new shares, or what they call at the market offerings, in the public market. The sales agent or the market maker that's doing that, and they collect a commission for that. And so oddly enough, the two types of funds are extremely different, and there's there's a lot I could go down with PSLV to explain the mechanism between that as well.
So before we get into some of the other things that I wanted to pick your brain about, I got to do some quick thank yous here. We have some new Melonhead members. Thank you, Mr. Jared, who became a Melonhead member. Welcome to the Melon Patch, sir, and thank you for supporting the channel. To Jared, and also Henry Homsher. Thank you, Henry H., who also has joined as a channel member. Just a reminder, guys, members get 1 free super chat a month. Feel free to use that super chat, and we can read and respond to your questions live on the air. So any of you Melon Patch guys who are watching right now, if you got a question for Bob, feel free to submit those that way, and we'll take a stab at it. And we got a few of those. Armando Reyes here, I think, showing a lot of the frustrations that a lot of metal traders are probably feeling right now. He says, we're living in an age of deception and betrayal. Everything is manipulated. Remember that we still aren't in a recession. The recession that never was, that began in 2022 and is still occurring right now. I agree with that, Armando. Now, as far as everything is manipulated, honestly, I really do. I'm inclined to agree with you, Bob, that today was about shaking out weak hands from a leverage perspective. This is about people who probably got into futures trading and just figured it was only going to go up in a straight line, never have a pullback, had no business doing it, maybe didn't have the capital needed to post those additional margin requirements. And then, of course, when the sell-off started today, they just got cleaned out. So, does that rise to the level of manipulation? if these events are engineered to shake out weak hands like that, you could make that argument. But I also think even a lot of us were expecting this sell-off, right? How many people expected this to happen at 50, like 500.00? We all expected this sell-off. We didn't expect it to start at 54. We got just below 54. I don't think we quite hit it. So maybe it came a little later. But let's be honest. I think most of us were probably expecting this, Armando. And he's reiterating that when he says the whole system is saturated with skullduggery and corruption. Don't forget dirtbaggery, Armando. Our ruling class is the perpetrators. You're making one hell of a sales pitch for the shiny here, Armando. So I'm just going to go ahead and throw this up here, guys. I keep my little 10-ounce bar here handy for just such an occasion. And just a reminder, guys, physical metal is a savings vehicle more so than a speculative asset that you want to try to trade in and out of. And, you know, if this is just a savings vehicle, as much as it sucks to watch $3 of that savings go up in smoke per ounce, zoom out on the chart and you know you're on the right side of history. So thank you, Armando, for zooming in on for supporting the channel. And Bob, anything along the lines, I know you have strong feelings about the manipulation arguments within the market. I mean, what do you have anything you want to add to what Armando was saying here?
Well, you have to look at how Wall Street works, how the markets work, and the profit motive that, you know, for example, the market makers have versus the opposite side of the trade, which typically is retail. Like I said before, the entire system is manipulated. I mean, if you looked at from the top, the 10,000-foot view, it has to be. There's no other way you can create the amount of debt and keep the game going for such a long period of time. In fact, the U.S. dollar is the longest lasting ever fiat currency, I think, in the history of time type of thing. I mean, it's typically most fiat currencies only last. I did this back in 2009, I believe. It was like 16 years before they ran into problems. I mean, we've gone a very, very long time, obviously since 71, really being completely disconnected from, anything backing the dollar. So it is, but, in order to maintain the power of the reserve currency, you get to make the rules. And eventually one day that country will, like us, those rules will not be adhered to by the rest of the world, and things will shift again, and power may shift, or you may see economic power switch or change. I mean, those are the natural evolutions of the markets over the history of mankind. So, but for me, for example, the gold and silver market in a period of time that we're in now are the only two time-tested financial assets, I think, in the world that have stood through every civilization of mankind, and it's still here. So, if you can tell me another asset that has lasted that long, that doesn't decay and have time value, the issues of dependency on promises of others and that type of thing, please share.
And Armando, I would just add another warning on the leverage here. When you hold the shiny, when you use this as a savings vehicle, you are taking your money outside of their reach, outside of the skullduggery and dirtbaggery and corruption. But when you start getting too creative and you go out on leverage and you get into these structured products and options trading, you are wading further and further into their world where you are just a guest, a visitor, and, well, you're on the menu when you do that. And days like today are good reminders of that, to please be careful on leverage. Thanks again, Armando. Go ahead, Bob.
One other thing too, which is being promoted a lot, the last year or two or three, is gold dealers and other companies are promoting now, borrowing against your gold, or these lease type of arrangements, to try and get people to say, hey, listen, we can pay you 4% or whatever the number is on your gold. Instead of just holding it, in a safe location or on your person, that type of thing, we can make some money for you. Those are leverage types of products that add risk to people's portfolios. And so when you get these down moves, especially if you borrowed against your gold, then you have the issue with the equity or the loan to value situation that may turn people into forced sellers. I mean, obviously we're only what, about 10% or so, a little bit more than 10% off the highs. So it's not like it's, you're probably getting really tight to, margin calls on, these private programs. But yeah, this is a reality of the public being sort of lured into these other types of leverage vehicles.
Great warning there. And Armando, you are most welcome. You didn't have, that was very nice of you, Armando. Thank you. You didn't have to spend $5 to say thank you, but very courteous of you. And thanks again, Bob, for taking the time to field those. I got an interesting one here from John, and I want to add my own little anecdote to this one. 1933, Executive Order 6102, which, if you're not familiar, that was surrender your gold, but don't worry, we're going to buy it from you for $20.33 an ounce before we mark up the value of gold and basically steal a third of your savings. But he says, gents, airplane mode or leave phones at home when buying bullion. History is bound to repeat, God willing or not, or God willing not. So I'm going to go ahead and I'm going to don my special attire that I use for just such an occasion. So airplane mode when buying bullion, is that to avoid your phone telling Uncle Sam where you're at when you visit the coin shop? Hey, I'm a nuclear engineer and we love redundant layers of safety. Let me just say, John, I think you're very redundant with your layers of safety if you're going on airplane mode before you go into the coin shop. If we ever get down to that level, I think you're better off stacking lead versus anything else. So, hey, it's the 2020s. Let's not rule it out. But I did get a kick out of that. Now, 1933 in Executive Order 6102. I am historically, Bob, very much aware of anybody pumping pre-33 gold. Slabbed gold, it tends to be very, very high premium. And I think that's one of the ways they scare people, using confiscation as a means of increasing their own commissions, because the higher premium stuff also pays the salesman a higher commission. But I noticed something last week, and I pulled the trigger on something I never would. I found some pre-33 graded double eagles. One St. Gaudens, one Liberty pre-33 double eagle. But they were trading for like $10, $13 over spot. For one was an MS61, the other one was MS64. Graded, really good condition coins in a slab for just over spot. And I remember seeing that saying, wow, the dealers must be desperate for liquidity if they're selling that at such a low premium. Did I get fleeced? Or, I mean, these were big online retailers, prominent dealers. So it wasn't, some schmuck on eBay that I bought it from. Did I get fleeced, or is it really that bad for the coin dealers? Were they really that struggling for liquidity?
Well, when you're talking about $10 over spot, are you talking about the coin itself? Because the coin isn't one full ounce.
Yeah, 0.9675 ounces. I did the math and I made sure, because it was about $13 over spot based on that fractional weight
melt
of the
value.
coin. Yeah,
got it. Yeah, those are products that you buy, correct, when you're getting close to melt value, or you're getting, there's a small premium above melt value. There's nothing wrong with that product. I mean, obviously it's an old product, it's a collectible. You can make it look, it may be something that just sits in your sock drawer and you give down to your grandkids. Expensive present, but it's the fleecing that comes, or the profiteering that comes from the industry, is when they get people all revved up on this idea of confiscation. Look what happened in 1933, and it's going to happen again. And this was the carve out. You could, you go on these, collectible type products that had a 15% premium above the melt value. So therefore it was, it wasn't part of that order. It's all BS. It is a scam. Unfortunately, a lot of people fall for it. These dealers that promote this stuff, they don't care about your purchasing power. They care about making money. And unfortunately, this is part of the industry practices that I think need to be curbed, because yes, nobody knows what's going to happen going forward. They may do something different, with a different executive order, but that executive order was back when we had gold backing our currency. And people were trading these gold coins. And back then, the whole idea of turning in gold was to actually try to increase the money supply and loosen up the hoarding of capital, so the economy could start turning over again. Money could start turning over and transacting rather than being held, at someone's house. So that was sort of the fervor back then. Nobody actually went to jail or was fined. One guy fought it, and I guess he was the martyr. He fought it and lost, but based on the executive order. But no, 75% of the metal that actually was actually turned in before the order was ever even put in place. I mean, there was a real push to try and get out of the depression somehow, and to try and support the banking system.
And it's not like they were going door to door saying, got any gold inside, right? They were going after big stashes of gold stored in secure vaults where there was a paper trail. A guy with some gold coins under his mattress or buried out in a field was not being forced to go out and surrender that gold unless he just, really wanted to be a rule follower. So you're avoiding accidents.
Yeah, not only that, you were allowed to keep, from what I understand, you were allowed to keep 2 coins from each dated year as well. So it wasn't like you just had to get rid of all this stuff. Otherwise, we wouldn't have that market today for that product. It'd be, in Fort Knox, melted away.
And that's why there's a lot of those out there with holes drilled in them, right? Because people turned them into jewelry and put them around. Oh, it's not gold bullion. It's a necklace. You just drill a hole in it and put a rope through it. Now it's a necklace. Sure. Why not, Mr. T? Thank you very much, John, for supporting the channel. Also want to say thank you to Tony for being a new Melonhead member. Welcome to the Melon Patch, Tony. Appreciate the support of the channel very much. Got some interesting, the sentiment is coming through. You can see it with what people are saying. Bought the dip. My safe is well capitalized. That is a very good way to put it. So, along the lines of what you saw today with your clients, Bob, people are buying the dip. And by the way, I think when he said his safe is well capitalized, I think he's trying to queue up my Janet here. So let me just real quick find my girl and say, Henry, rifle owner, PA, is strong and resilient and very well capitalized. Thank you very much, Janet, for weighing in on Henry there. Okay, I lost my place here because I think I skipped over my buddy Dan, who probably just said, hey, he skipped mine. Sorry, Dan, we're going out of order today. But might be off $3, but he's still up over 125%. Not bad, right? Great problem to have, Dan. And, especially I'll take this. I had a conversation with somebody not too long ago. Somebody sent me an email talking about how much they were up, and they were trading call options with some of the ETFs. And he had mentioned that he had just taken some profits. Actually, I think it was yesterday I had this exchange. I can't remember the guy's name off the top of my head, but very good trade. And just a reminder, guys, take profits when you can, especially on leverage. The clock is ticking when you can and can't take those profits. So congratulations, Dan, and thank you for supporting the channel, sir. Seems like I got some we got a lot of medalist enthusiasts here. Some the metal that goes faster than others. He says, with you on the lead, brother. And Bob, I've seen some of the toys that you guys are playing with over there at Idaho Armored Vaults. I think you're down with the second as well.
Yeah.
All right. Now, Bob, you've been very patient, and thank you, John. Thank you, everybody, for supporting the channel. There was this tweet was going around. I know you're just like, let me at him. Let me at him. This one from Alex Jones, of all people. And you put this out on Twitter, said, I'm sorry, but nearly everything mentioned in this video is wildly incorrect. The lack of facts and complete fear-mongering has gone off the charts. Do investors actually make investment decisions after watching this? I hope not. Certainly not the melon heads. Says, would gladly discuss and clarify each incorrect point made in an open forum. Well, Bob, this is your open forum. We're gonna watch some of this. I have one of the reasons why we're just a few minutes late starting this one, guys. Thank you for your patience. Is I wanted to cut this into pieces and play it for Bob so that he could respond to these point by point, because I think this is some of the practices that you're not particularly fond of were laid bare here in this video. So this is a guy named, what is his name? Kirk. What was his last name? Kirk, Dr. Kirk, we'll call him. And he was on the Alex Jones show talking about the silver squeeze. Now, this was yesterday. Guys, just a real quick, check your audio levels. Sometimes StreamYard messes with the audio levels, so stand by on your volume control. It might be a little loud when it first starts playing. I do my best to level these things. But here is the first clip from the Alex Jones show about gold.
London ran out of silver, right? We talked about how the chief commodities analyst at TD Securities said London was going to run out in 4 months. It didn't. It like
and I
has
said
run out
that
now.
day a month ago. I said, I bet that creates a run. It runs out even quicker.
Oh, it did. And so here's where the political dynamics are going to. So London ran out, and you've got all these people with short positions, Bank of America, JP Morgan Chase, whatever. They have 770 million ounces of silver in short position, where there's only 500 million ounces produced in a given year. What does that mean for the banks? They are going to be squeezed. When you run out of a short position, you exit it, you have to buy the metal for delivery if that's what the counterparty wants.
All right, so the first thing I can't get out of my head, Bob, is I'm pretty sure this guy is Bob Sapp's Caucasian stunt double. I look at this and I can't help but think this is white boy Bob Sapp. All right, that being said, there was some pretty hyperbolic points in that first clip there. Go ahead, man. This is who I just wind you up and let you go.
Sure. Well, just to kind of go through it, I kind of took each quote that he made and just sort of a comment about it. When he talks about London ran out of silver, there's at least 100 million ounces in free float there. In terms of and then they talk about runs out even quicker than they thought. This is sort of a panic style type of selling mode to try and get people to buy metal. It's not looking at the facts of what's actually transpiring. The metal that's being moved out of New York, the metal that's being moved from refiners or from other locations that are going to London. So they don't really put any context in. When it talks about the 770 million ounce short position, that I'm not sure what he's referring to. But in terms of the 500 million ounces produced a year, it's actually over 800 million ounces produced a year. So there's 300 million ounces, give or take. Making up.
That's an apples to potatoes comparison, right? You're talking about annual mine production versus free float in London, right? Versus cumulative short positions, and most shorts are not settled in physical delivery; they're settled in cash. So, that's misleading when he's talking about mine production versus what's there. And, you touched on the free float in London also. That's important too, because, I've been partially guilty of this. I've used phrases like things are getting tight in London, or London is running out of silver, as in the free float was in decline and it was declining rapidly. And I think he made reference to a TD analyst. There was a note that said at the current rate, the London free float would be exhausted in so many months. But at that current rate, the price would also be approaching God knows what if it had continued. So, I think he's taking little bits of true data, rearranging them in a slightly dishonest order and trying to create the impression of panic. And, that's the kind of talk that gets people to go out on leverage, and then they get cleaned out when you get a sell-off like today. I'm sorry to interrupt you, but
No question. Or even worse, you end up paying a premium for a product, an excessive premium for a product that because you're in that anxiety or sort of hyped up mode to say, oh my God, am I going to miss out on this entire move? Is there going to be any silver left? And so you're right. Now, when you talk about it goes, when you run out of short position, you have to buy the metal for delivery if that's what the counterparty wants. What he doesn't understand, obviously, he doesn't have an understanding of how or what's transpired this year. Earlier this year, the banks were big buyers of physical metal, delivering it to the COMEX and writing futures contracts against that. And they don't simply just go out and short the piss out of the futures markets without any metal. They work on spreads. So the industry traditionally will, in most instances, like we saw earlier this year, they call it a contango, where the futures price is more expensive than the spot market. So you buy the physical, or you buy a spot contract or a spot deferred contract and then you go and turn around and you sell a futures contract against that, and that spread is a profit margin. It's a very typical bank activity or market making type of activity. Hedge funds do it. A lot of different players will do this. What they don't do is speculate or go on a secular type of trade where they're saying, I'm going to bet against the market, and if I'm wrong, I then have to go out and find the metal somewhere. The banks just don't operate that because they're working on leverage as well. They're working on borrowed capital, so they have risk parameters that they have to work in. Anyone who's watched the movie Margin Call, for example, you have these engineers that like yourself that build these models to protect them against standard deviation type moves. You don't want to get into that situation because it can get really illiquid and really dark really fast. So typically when you see this happening, they already own the metal. It's now what's happened, what's transpired is the pricing dislocation that was created a few weeks ago when we went into a steep backwardation. It now became very profitable to now close the short position out, deliver the metal over to London, and grab that $1.50, $2 premium that London now is over the New York markets with. So now essentially you take delivery in New York, fly it over to London, even if it costs 25, 35 cents an ounce to fly it over there, you're still walking away with $1.50 pure profit per ounce. And you're talking millions of ounces. This is a game that's beyond, the retail guy. I mean, this is large money that's being shifted around. So that's typically what's happening. It's not a bank that's just going to fail tomorrow because they can't find the metal. They've already, the first part of the transaction is getting long something and then shorting or using a hedge as the other leg of the transaction.
Yeah, and you did an excellent job last week talking about that when we saw that big dislocation between London and New York popped up, and you accurately predicted we're going to see metal start to get on planes and head to London. We saw millions of bars leave the COMEX, and I haven't gotten confirmation that they're showing up in London, but I'm pretty sure that's where they're going because we've seen that spread start to contract to just, what are we, like 60, 70 cents the last time I looked, down from over $3 at one point.
Correct.
Now, in this next clip, I'll just play the clip. I think he gets particularly egregious in this second clip here. I'm going to play this for you guys now.
Yeah, London ran out. There's no silver to buy to fulfill the short contracts. So now the lease rates have gone to 100%. The lease rates mean if you're a refinery, and this is very important for the whole political dynamic monetarily, if you're a refinery and you're producing 100-ounce bars, 10-ounce bars, 1,000-ounce bars, whatever, and you're holding them in free float to sell, that means to sell with a lease rate of 100%, silver at $52, that means you're paying $52 an ounce for a whole year. Divide that by 365, it's 15 cents an ounce per day to store it. So basically, refineries aren't producing right now because the cost of carrying it's too much. They can't do it. So now there's no supply. All roads lead to London.
All right. So that, first of all, his math was off. That's 14 cents a day. But we're nitpicking here. We'll give him a rounding error. What do you think about that clip?
Oh my God. We got to start here somewhere. Again, London did not run out of silver. Just because lease rates are high, that basically is a symptom of tightness in the market. It doesn't mean that they're completely gone because the cure for high prices is high prices. I mean, someone's going to come in and deliver metal at some point. But let's just we'll walk through this. So the 100% move, or I guess the quote that he mentioned, I think that happened on one day. I don't know if there was actually an actual contractual agreement that was made that any party actually made. It may have just been someone had a bank says, hey, listen, 100% today. It's I don't know if anybody.
Why would
took
you
the
lease
offer.
something for the price of buying it outright? That just defies logic.
Yes,
maybe that happened for the blink of an eye, but
right.
That struck me as BS right away when I heard that 100% lease rate claim. And I've seen
Yeah.
that in a few different places.
Yeah. So you have to take a lot of this stuff with a grain of salt. And you have to remember there are a lot of parties that deal with a lot of different transactions in London. There's a lot of contractual arrangements. There's like big mining companies that have an ongoing relationship with these banks. Their lease rate is not going to jump to 100% tomorrow just because of the fact that London's tight. They have contractual agreements as well. A lot of times this impacts some of the outlying players that just happen to be on the wrong side of the trade. But we'll go through this. The talks about the refiners not making metal, which is completely untrue. They have been working overtime trying to process metal. In fact, they've been turning it away. There's been so much metal coming in, especially in the U.S.
I want to pause you, Bob, and I'm sorry to interrupt. That is such an important point because the refiners are operating at capacity. They're turning away low-grade metal because they've got more than enough of the pure stuff to melt down. This idea that the refiners are not making metal, I don't know where the hell it came from. That is bunk. Refiners are making metal as fast as humanly possible right now to capture these higher prices. Again, I'm sorry to interrupt you, but you hit an important point there.
Yeah, and you have to remember, again, the refiners can also capture the arbitrage. They have trading desks as well. So they may be, Sahi has put together a very big operation here in the United States. They have a COMEX depository. They probably have a very good trading team that will use the metal that they produce with their balance sheet to then put onto the COMEX, sell futures contracts against it, or deal with the arbitrage situations that way. So there's a lot of ways that refiners can make money. But the idea that they're just going to stop taking in metal, you have to remember, they're taking in contractual agreements with mining companies that are constantly delivering product on a weekly basis. It's not just simply, they're taking in just, wholesalers or other retail dealers that are trying to unload scrap or 90% or sterling or whatever it may be. There's a whole slew of different participants that are sending metal to the refiners. So that's one of them. And then let's see. I'm just trying to.
You called out correctly here that he's kind of mixing up leasing and refining, which are two totally
storage,
different animals, right?
Yeah, he's talking about storage and leasing, which are two totally separate businesses. Storage is not a financing cost. It's basically a carrying. It's part of the carrying cost, but it's not the financing side. So you can store metal. It's not going to cost you 15 cents a day to store metal. That would be a complete ripoff if anybody was charging that. But so that they can sit on metal too. You have to remember. There's the refiners are in the business. They have different types of clientele that will want metal, or they may want to lease from the refiner. There's different types of different types of businesses so it's not just simply buying and selling black and white type of thing. So, but yeah, that was to me that was I guess kind of go through that clip.
The one other thing that we touched on here with the refiners turning away the low grade stuff like the sterling and the 90%. I am on the lookout daily for good deals on junk silver right now, guys. This situation will not last. Junk silver is available under spot in most places right now. I'm sure Bob can get people a really good deal if they are looking at junk silver. I have been buying junk silver this year as well. This situation with refiners turning away 90%, it's not going to last forever. So, if you are dip buyers, I can't tell you what to do with your money. I can tell you what I'm looking at. That's where I'm looking to find deals right now, because I think junk a few years ago was trading at a ridiculous premium above spot. And now you can get it for, in some places $1.25 back a spot. So there's good deals.
Yeah. And the one thing I was going to say, the last comment they made, all roads lead to London, is not necessarily correct.
Yeah, there's plenty of roads that go to Shanghai and to India and to New York right now. There's a lot of places you can get metal.
Yes.
All right, we got another clip here. Let's just roll that beautiful bean footage.
Yeah. So in London they ran out of silver. It's like gone. when these big banks have to fulfill their short contracts, they have to buy silver. Where do they buy them from? London. There isn't any there. So these big banks that finance these transactions are saying, well, wait, that's like a really risky transaction. So this is why the lease rate went up. They're afraid that London isn't going to get the inventory because they don't know what's going to happen with Trump's Section 232 regulation. Are they going to consider silver as a strategic metal or a rare earth material or not? So the banks aren't willing to lend any money to settle transactions except at 100%. Well, so because that's so much, London, what do they have to do? They have to jack up the spot price to where it's now $2 greater than the futures price. And still, nobody's sending any metal to London to fulfill all these contracts. All roads lead to London. Every single metals transaction, even in America, has to go to London first.
Before we get into this one, I just realized I didn't warn my moderators that we were going to be playing Alex Jones clips today. I think I owe my mods a beer. M&J, Nan, Mish, I love you guys. Sorry, did I forget to mention that we were going to be taking on Alex Jones clips today? Oversight on my part. Thank you guys for everything you do. Being a moderator is a thankless job in this space. So he started with that London ran out thing again. I guess let's just glance right over that he repeated that again. What did he get wrong in that clip, Bob?
Well, I guess if London ran out of silver and that's where we get our silver, how does he sell silver to his customers?
That's a good question. If there isn't any, how are you selling it? And why at such a low, affordable price? That is now $3 less than it was yesterday. That's interesting.
Yeah, I mean, and you see a lot of this with the retail dealer world. Oh my God, it's just, and I saw this a lot in 2021. You had, in fact, with I think it was players or people that were affiliated with Sprott were talking about, how they couldn't get the silver, to fill the PSLV. And I put a post out. We bought $16 million worth of 1,000-ounce bars and placed the order. 3 weeks later, we got it. I think that was around April, May timeframe, right during the gist of that whole thing. It's that type of fever that gets people sort of worked up and supporting those types of individuals because they're like, hey, this guy's for the little guy. This guy's, bucking the big brother, type of thing. But all they do, they're just salesmen at the end of the day, unfortunately.
Yeah, and that stuff moves metal. We've seen it. It convinces people to part with their money. And M&J saying, "Big trouble, buddy." that's my moderator cracking a joke, saying, "Sure, you love me." Yeah, I'm in the doghouse with the mods for not giving them a warning on this one. Okay, let me bring up my media kit again because we got one more clip. We got one more to go through, Bob. And
I can go through if you want. I can go through the rest of that clip if you want me to.
Oh yeah, we didn't even talk about the 232 thing that he mentioned in that last clip. Go please go ahead.
Yeah, I mean, it's in terms of, again, not to belabor the point, but the banks already own the metal, then they put the short position on. It's not the other way around. And then the 232 regulation. That's something we're all kind of watching for. I mean, it has ramifications. If they decide to tariff silver, that metal is going to stop flowing to New York or stop flowing to London, and you're going to see the thing whip. The backwardation is going to go into a very steep contango if that happens.
But can I pause you on that one real quick? The 232, that's a national security investigation. I forget the name of the act that it's carved out of, but it's basically the decision of whether or not to tariff silver, because silver was added to that critical minerals list. And right now there's an open investigation into whether or not we should tariff critical minerals, which may or may not include silver. We just don't know yet. Now that is a risk, right? That could come back. Yeah, we're going to tariff silver and all hell breaks loose. I mean, that's going to be a mess if they do that. I'm inclined to think they won't tariff silver just because I don't know what we gain by doing it other than throwing a monkey wrench into the whole global financial system. And maybe that's what Trump wants to do. But I think right now the market probably isn't thinking that's going to happen. Go ahead.
The idea behind tariffing a product or commodity is to try to get the within the United States activities going to actually generate that product or commodity itself. If it's silver, for example, it's to try and give incentive to miners to say, listen, go out and find that silver in the United States. Because we'll protect you with these tariffs, so that price will be higher. So your cost of production, it makes it easier to go, gives you incentive basically. That's the idea behind it. You're right. It doesn't. When we're a net importer of 330 million ounces a year, you'd scratch your head and go, why the hell would we tariff something that we desperately need? And that's, of course, why it's on the critical metals list. And this is one of the reasons why, the silver story is not one of these one and done type of things.
And do you think the 232 investigation is at all informing the situation with New York and London right now? I mean, if I'm looking at capturing, say, rewind 2 days, and there's still a $2 arbitrage to move metal from New York to London, am I going to look at that 232 investigation and say, no, I don't want that $2 an ounce? Do you think?
No, because right. Because what you'll end up doing is your job is, the banks again their job is to make money. The trading desk is to make money. They're, just think of the traders on the desk that get compensation and performance incentive fees and things like that for doing a good job. Whether they're spoofing or not, it's another story. But but the idea though is to try to make money in the game. If they move the metal over there, and then all of a sudden, guess what? The 232 tariffs come into play. Now you got a big fat contango. Now the issue is, okay, you could try to now deliver metal back into the exchange, sell your futures contract against it, and metal, that metal's going to be moving around again. It's just the world we live in today. It doesn't mean that the whole thing's manipulated. That's just the way the whole structure's set up. The other thing I was going to mention too, when he talked about banks are not willing to lend money to settle transactions except at 100%, that's complete BS. Because if the banks did not provide liquidity and capital to its customers, the customers would actually go out of business, not the banks. If the banks make money on the spreads and on the lending of their capital. That's the whole business. So I don't know why they would just stop doing that.
Yeah, I don't know why he really clung to that 100% lease rate. And honestly, I don't even think that I think he's talking about the 100% lease rate here, but lend money to settle transactions, that's not even leasing. So he's taking that 100% lease rate and he's using it to apply to, I don't know, like credit lines to traders. This is like apples to nuts and bolts now. I don't know what he's comparing it to.
Yeah, and then they talk about jacking up the price of London $2. That is what they call a backwardation. Actually, where the futures market actually went down, not you could say the futures market went down or the spot price went up, but it's not somebody that says, okay, let's just jack the price up $2 on London because we feel like it. That was due to a lot of the capital flows, the gamma squeeze in the options market, the creation of shares in ETFs, the demand for silver. Those are all things that created that backwardation, not just simply a swipe of a pen.
Yeah, and that's the free market providing a solution, right? They needed more metal in London. They didn't run out, but they were running out. They were getting low. London starts trading at a premium. The market provides. The metal leaves New York and it goes to London. It's not a function of manipulation. It's not a function of, men in big hats in dark rooms. They needed metal and the price had to rise to provide it, and the market did. I mean, I don't know that I would say a functioning, healthy market, but something was out of whack and the price moved to accommodate it. Did we get to all your points on that clip, I think? Or did I?
Yeah, I think so. Yeah.
Okay. All right. Last section of this clip here. And then I'll let you react to this one as well.
Yeah, China, India, COMEX all have inventory of silver, but it has to go to London to fulfill transactions. This is the problem. They're not willing to release it because they know they're squeezing London, right? And so tomorrow, the lease rate might be 250. Maybe the next day it's 3. Maybe it's 350. Maybe it's 5. So ultimately, instant arbitrage opportunity, buy silver in China, sell it in London for $5 more per ounce, instant profit. Here's my question politically. Does China care about the profit? Possibly not. They know if London raises the prices on silver high enough, they're going to go bankrupt. And China could usurp the entire Western financial system by putting LBMA out of business. I mean, this is where we, as the holders of metal, can absolutely profit from this political dynamic where the banking power of the West, China's trying to take it away.
All right, China's trying to take away our power. I better hurry up and go buy metal. What's going on here, Bob?
Yeah. Red Dawn.
Wolverines.
Yes. My God, we got to go through this. I mean, I wrote some notes down, so I'll just read from that. The idea that other markets are trying to squeeze other markets is preposterous. You can't, as a general, I mean, as a large market, New York or China or whatever it may be, to get an entire location to say, listen, we're going to squeeze the crap out of London because, it's like the movie Braveheart, we're going to storm the gates or whatever. It doesn't work like that. It would actually create dislocations everywhere, and it may come back to backfire on them because the pricing structure would be such that, well, prices are higher in London. I can make absolute profit, in a moment by getting my stuff over there and selling it over there. There's no nefarious attempt to squeeze London. It's part of the entire system. It just happens to be that London is where a lot of the spot market and physical market transacts with ETFs and things like that. So there's sort of a center of structure there. So it's really more the capital flows and derivatives have created the mismatch, not necessarily these specific locations like Shanghai or New York or India, that type of thing. The idea that lease rates are going to go to 250, 300, 350. I mean, it sounds like an auction. Or an auctioneer just saying, well, let's go to 500. Anyone take? I mean, you would have players just basically just shut their doors and close. You would have a massive deleveraging event where the price of the metals would collapse, most likely, because it'd be margin calls. It'd be no one would carry any inventory. It would be dogs sleeping on the cats. I mean, it would be a disaster. It's that the lease rates are just showing the degree of tightness in the market. That's all it's basically showing. And then it's interesting that how he uses China. This is another one of those tactics that I know a lot of people in the precious metals world say, listen, China's going to rule the world, and maybe someday they will. I don't know. But using that as a political sort of selling point to say, listen, those are the guys that are going to control the market, and they're the ones that are going to basically bankrupt the Western governments and society. That's the gist that I kind of got from that. It's not that China would pull back delivering metal to London, because a lot of the refiners in China actually do business in London. And if you look at SLV, for example, a lot of bars stored in SLV are Chinese refiners, oddly enough. So he doesn't know what he's talking about when it comes to, it's making these types of observations that are more done from a sales tactic than it is from, any type of knowledge base. Which is unfortunate, because this is what starts to get people really confused on, the manipulation story or what's actually happening in the markets. And then you have this big drop here, and then people are going, why the hell did I buy 54? London was never going bankrupt. And, now this stuff actually came true. So in terms of, the idea that London would raise prices and then bankrupt itself, maybe you could explain that one to me. I've never seen anyone go bankrupt with prices going up, unless you're short the market.
Yeah, it's a bold strategy, Cotton. We'll see if it pays off for them. No, nobody would intentionally bankrupt themselves. I agree. I mean, is he
Yep.
just tapping into BRICS fears here? I've seen so many people pumping the BRICS story. And look, I know BRICS wants to get off the dollar, but why haven't they? We've been hearing this crap for years. They haven't because they can't, because getting off the dollar sounds great in theory, but it's just really hard to do. And it's next to impossible to do when you have your own problems going on in your country that you're trying to print your way out of, like the Chinese real estate collapse. So this BRICS fear mongering just always bugged me the most.
Yeah, I mean, I get it. A lot of countries are trying to relieve themselves of trading the dollar as an extra expense to maybe dealing with trade between two countries. You're having to go through a third party, so to speak, and to remove that third party, yeah, it makes a lot of sense. But yeah, you're right. You have to trust the other guy's currency and its convertibility and so forth, or use that currency to buy debt of that country or whatever it may be to store those reserves in. The other thing I was going to mention, talking about China, using this as a sales pitch to bankrupt the Western system. The LBMA is not the banking sector. Yeah, the LBMA is a marketing organization that's made up of OTC or over-the-counter participants. It's not an exchange like the COMEX. So it's important to kind of distinguish these two. Just because LBMA participants run into trouble doesn't mean the entire systems fail. So that's a little bit, just a small clarification there. And then just there was one other thing.
We as the holders of metal can profit from this political dynamic where the banking powers of the West, China is trying to take it away. Can't let the Chinese take away our power. I better dial that 800 number, I guess.
Yeah. Yeah, again, that's to me, it's like you said, it's more of a sales pitch, to promote, some type of theory, I guess, to get people, to buy metal.
So, like take all this stuff in aggregate, right? I mean, this came out yesterday, right before this massive sell-off. So if you listen to this kind of stuff and you panic and you go out and you pour your savings into metal, you got clobbered today. There is a lot of fear-mongering garbage out there, guys, and you need to protect yourself from that almost as much as you need to protect yourself from the decline of the dollar. Because if you make a knee-jerk decision and you end up overpaying on premiums, or people put you into these weird fractional denomination crap that comes with a really high commission for them, and you don't know because you don't have a calculator right out, and they talk really fast and they prey on your patriotism or your religion, your faith, or any number of things that they might use to win your confidence and make you more likely to trust them. You can lose money that way just as fast or faster as you can letting inflation eat it up in a savings account. So just be careful. Don't fall for these high pressure sales tactics.
Yeah, and just to give people an idea, because there's a lot of promoters, mints, gold dealers that are yelling shortages and sort of fanning the flames of what we saw in 2020 to 23 all over again. Premiums rising rapidly. I can walk people through what's actually happening to give people really a sense of sort of the bigger picture. There's not a shortage of silver. In fact, there's actually still a lot of it, and it continues to flow into refiners to be melted into 1,000-ounce bars, for example. What's happened basically is that, and what dealers and these promoters are not telling you, is that the Mint was shut down for 2 weeks to do an audit, the U.S. Mint, back in September. To kind of go backwards even more in time, over the summer, you had basically a lot of people selling, not a lot of buying. You had a stack up of inventory on a lot of dealers' plates. The carrying costs were eating them alive. The Mint came out, I think, in August and said, listen, we need year-end allocations. Tell us what you think you're going to need for going into the year-end. Everybody came in light because they were already filled to their gills with backdated product. You also have, at the same time, in September, the Mint goes into an audit. It shuts down. It doesn't take any orders. You also have, which happens every single year, you have a crossover in new mintage years. So, for example, the 2025 coins stop being made in September, October, November, and then all of a sudden you start to see the 2026 product being made, and then the delivery times on those 2026 products may be November, December for Royal Canadian Mint and British Britannia's, and it's usually into January is when the Silver Eagle program actually starts delivering their 2026. So you have this gap in time that creates this potential degree of tightness, temporary tightness, until the next production year starts to come into the market. That's what's transpired. So a lot of and these products, the sovereign coins, are the most popular of silver products out there. So they are the American Eagles tend to be the first thing bought because people really like them. It's one thing the U.S. government does right, I guess. And so what happens is the premiums start to rise because there wasn't a lot of product accounted, or basically the industry caught itself flat-footed, in all honesty. And so with that in mind, all of a sudden you got September, market takes off. The futures markets, the options markets start to rev up. Mining stocks, capital flows are coming in. Mining stocks are going up 2% a day. I mean, it's like the momentum guys start coming in. Money attracts money, and this thing starts to catch fire. Well, you have a lot of people that weren't making physical product because they were all, coming off of the summer. Everybody, had too much at the time. So that started a run in the market, and started to grab up a lot of the backdated stuff. And as the market kind of picked up steam, the retail public, which, I would say retail, but higher net worth individuals started to say, listen, this gold story is starting to light fire. Ray Dalio and all these big guys that aren't gold dealers are saying now 20% in your portfolio. Oh my God, the dollar is in decay, and we need to protect ourselves. So you start to get big money starting to flow in and buying these products up, very specific products up. In a fell swoop. And so you get a degree of product tightness that sets in very quickly. And at the same time, you don't have excess product being made currently to absorb, to provide that supply. That's what's happened. And so you have a dislocation in products. For example, junk coin, the premiums are diving. I mean, it's, you can buy junk coin for, I think it's $1 under spot on my site. I mean, it's been at a discount all summer. But that product has been going down, whereas the retail products like 100-ounce bars and 1-ounce rounds, those premiums are starting to lift a little bit, only because nobody was prepared for this. That's why you got to be very careful and not overpaying for metal. A lot of these dealers that I'm seeing online, and I posted it today, I'm selling 1-ounce rounds for $1.60 over spot, where I'm seeing the exact same rounds basically being sold for $5 over spot by all these big online dealers. That is, to me, that is a symptom of where there is no fiduciary responsibility. It is make as much money off the client as possible. Otherwise, those premiums would not be as high as they are. And then also look at what they're buying these same products back at. Understand those spreads, because those spreads are very, very wide at the moment as well.
Yeah, those $2.50, $3 over spot American Silver Eagles were nice while they lasted. Something told me that wasn't going to last. I'm seeing 6-7 now at the cheapest. So $5 over spot for generic rounds is highway robbery in this situation right now. I mean, maybe some of these situations going on overseas where the tax structure is different, I could see that. But here in the States, no way. I do think junk silver here, the 90% constitutional, is a fantastic deal at these price levels because of the situation at the refiners. I don't think that's going to last. I think we'll get back to where those are trading at a nice premium over spot eventually. So, again, if I had money to go put to work right now, that's where I'd be looking to buy it, is the cheap stuff. And, look, they're not making any more of it, that 64 and earlier stuff. And they're melting down a lot of it right now. Maybe the stop the melt worked. They're not melting down so much of it, but there's less and less in circulation every day. And go ahead. I just wanted to thank Pasta Man real quick. He said, dude has a PhD in economics. What? That was Dr. Elliott, we heard too. Hey, in Dr. Elliott's defense, let me just say I have no finance degree. My background's mechanical engineering and nuclear. So, I try to be transparent with my qualifications. But yeah. And by the way, along those lines, I said earlier in the show that I'm pretty sure this guy was Bob Sapp's pasty stunt double. Come on, guys. I mean, is it just me? Am I the only one who sees Bob Sapp there when we bring this guy up? Come on. It can't be me, right? I'm not the only. Anyway, yeah, and all that, and a PhD in economics. Thank you, Pasta Man, for supporting the channel and for the laugh, sir. Bob, we're getting a little long in the tooth. We've been going for about an hour and 20 here, and midnight is mauling my feet as we speak, trying to tell me I need to cut it short. So I'll let you wrap it up, and then we'll talk about your website real quick before we go.
Sure, no, definitely. It's just be careful in these markets. Try not to use leverage. It's something I've always kind of preached in terms of, especially for people that are long-term oriented. Silver is a leveraged financial instrument in and of itself. It's very volatile in price. It's very small market. So just be wise. Don't get too aggravated or upset when you see these big drops. This is just part of the breathing of the market. As fast as it goes up, you can have these retracements. But over the long term, the question you have to ask yourself, has anything changed? Has the story changed? And like you mentioned, I think the biggest key, if you want to walk away right now with the markets of saying, hey, listen, it's silver top. I think you nailed it when we talked last time. The gold silver ratio, I don't think has ever seen a top with silver at 80 on that ratio. You have to see that thing drop down to 30, I think, or lower to see a silver at its, at maybe that big price spike. So from that perspective, right now, all this is just a pullback.
And we're seeing the gold to silver ratio right here over these last 4 or 5 days shot straight up here, currently at 85. That's off of lows of around 78 that we hit a few days ago. Still, historically, silver is cheap relative to gold, although it's a lot of bit cheaper relative to gold than it was a few days ago here, because silver has sold off pretty well. And Bob, what we're looking at here, this is goldsilvervault.com. This is your website for Idaho Armored Vaults. And yikes, brother, you got 90% silver mixed halves, 34 times. Is that? Oh, okay. Yeah. I'm sorry. 34.16.
Yeah, divide that by, what for people that don't understand junk silver, just take that number right there and divide it by 0.715, and that'll give you the price per ounce. So if you want to just do that real quick, you can tell people what that converts to.
47.77. And right now we're looking at spot silver is 48.60, and the front month contract 48.14. So almost $1 back a spot on the website there. So pretty good deals to be had here. And once again, that is goldsilvervault.com. That's Bob's website. And while we're in the neighborhood, Bob, I also want to throw up your Twitter feed here. Again, if you guys were following this, you would have seen those new shares of SLV coming. Maybe you could have predicted this pullback a little bit. That is at Profits Plus ID on Twitter. When it comes to metals and metals commentary, I found Bob is the best. That's why he's a frequent guest on this channel. We are very fortunate to have you with us, Bob. Thank you so much for taking all this time on very short notice. I think I gave you like 2 hours notice that we were going to do this today. So thank you for making the time. I know it's getting late over there. Any final words before we wrap it up?
Yeah, I hope this has helped people. I'm not a big fan, and I'm not a big supporter of the speculative type of frenzy that I see a lot in the industry. So I try to keep things as educational and as sort of even keeled as possible. So hopefully this has helped people.
It helps me very much, and I know it helps people. I've been getting great feedback on these videos and live streams that we've been doing together. So thanks again for that. All right, guys, it was one hell of a day. Shake it off. We'll be back tomorrow morning, regular time for our live stream. Thanks again to Bob Coleman, CEO of Idaho Armored Vaults, and at Profits Plus ID on Twitter. And everybody else, until next time, live small and dream big.